Hey guys, welcome to the TradeWave Academy. So in this particular video, I'll be teaching you how to avoid market volatility spikes. We've all been in trading situation where you're quietly trading and all of a sudden you just see a very long spike like out of nowhere, takes out your stop loss and starts heading down or up to your take profit level. So what I hope to achieve in this video is to teach you my own personal strategy on how to avoid those kind of situations 50% of the time. This is a very simple strategy that everyone out there can actually implement. It's really a very simple thing. So if you stay with me to the end of this video, I'll be teaching you this particular strategy, teach you where and how to put your stop losses to avoid those kind of situations. Okay, so that said, stay to the end of this video and learn this particular simple strategy. It will really help a lot in your trading. So let's jump right into the chat. Hey guys, so welcome back to my screen. So I'll be sharing with you and teaching you how to use the ATR to actually fail-proof your stop losses, to make your stop losses much more fail-proof to market manipulations. Of course, we've all been manipulated at one time in the market where you put your stop loss and before you know it, market just spikes, takes out your stop loss and start moving straight down to your take profit. Okay, so it happens once and again in the market. So in this video, I'll be teaching you how to actually make that happen much more less and how to make your stop losses much more harder to hit in the market. Okay, so I'll be teaching you how to use a very simple tool called the ATR. Okay, it's an indicator called the ATRs. Now before we jump go into the chart and I start off telling you how to use the ATR, let me quickly just define the ATR for some of us here that have zero knowledge about the ATR. Probably this is the first time you're hearing about the ATR indicator. I'll be showing you how it actually works. So it's called the ATR, okay, which stands for average true range. Okay, sorry, I'm writing this with my hand, so I hope you do bear with me. It's called the average true range. Okay, now what the average true range does, it simply measures the high and low and the open and close of a particular number of candlesticks and gives you the average range of the bars. Okay, for instance, let's say average range has a period. You can set the ATR period as, let's say, sorry, let me use this clean sheet for this since we've already established the meaning. So you can put ATR period as, let's say, ATR period equal to, let's say, 10. When you put ATR period on 10 and put the ATR on, let's say, a 15 minutes time frame, okay, M15 time frame, okay, sorry about this, my writing, right? So ATR time frame, if you put this on the 15 minutes, what it does is it just calculates, okay, it calculates the bars. Let's assume this is the number of bars, calculates 10 bar up, something like this, then let's assume this went up again. So 1 2 3 4 5 6 7 8 9 10. So it calculates the open and close, 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 the number of pips of these 10 bars and gives you an average value. Let's say the average value of this 10 bars is let's say 15 pips. Okay, so it gives you the average open and close, the difference between the high and the low of the bar over 10 pips. Over 10 pips. Okay, for this case the average is actually 15 pips, okay, from what we just imaginarily calculated right now. Okay, so that's basic about how the ATR actually works, right? So let me now show you how to actually apply it. Now for the sake of this tutorial and for the sake of training, I actually use the 14 period ATR. 14 period ATR simply means that it calculates 14 bars behind, then gives me the average value. Okay, now it's much more advisable to use the 14 period ATR when you're using, let's say, 1 hour time frame, 4 hour time frame. In fact, 1 hour and 4 hour time frame are the of course I use on a 15-minute, but however I actually trust the 1 hour time frame ATR much more. Okay, what it does, it calculates the number of bars over 14 hours ago. That's if I'm attaching it on a 1 hour time frame, then it gives me an average. Okay, now what that helps you to assess is the most possible number of pips that the market might likely spike in a situation where there is just a sudden volatility in the market. Because probably, of course, we've all traded, been in a market situation where the market is all quiet, like everything seems like it's just dead. Then all of a sudden, even without a news event, just all of a sudden you just see the market just move, maybe move 10 pips, move down 15 pips, then move up again 20 pips, those kind of spikes. Okay, so what the ATR does is to give you the average possible. Please mark my word, just take the words I'm using, because this is like the best words I found out I could use to explain this. Okay, it's like the best possible number of pips. Okay, the highest number possible number of pips that a volatility spike can actually happen. Now, for instance, let's say as you can see here, the ATR, if I put this over here, the ATR, this is where my ATR, as you can see, ATR 14 period. Okay, so if you just keep swiping, it just keep, as you can see, the value there just keeps, keeps fluctuating. As at this point, the ATR was 12 pips, as you can see. As at this point it was 14 pips, as at this point it was 14 pips too, then it was 15 pips at this point, then it was 11 pips here. Okay, so like that. So when we get to the end here, as you can see, the current ATR value is 9 pips. Now, for instance, I want to maybe scalp or maybe just enter a day trade, a trade I hope to just make some profit and close out for the day. I always make sure that my ATR, that my stop loss is always at least 1.5 or 2 times higher than the ATR value. What that does is, in any possible instance where there is a market spike, the market spike, this is a theoretical aspect of using ATR. The market spike most times is almost never higher than the ATR value. Okay, so if for any reason something happens, aside news events that can really go crazy, like this ATR thing doesn't apply to like non-farm payroll, core CPI kind of news and all of that. This is for like, there's regular quiet markets where almost nothing is actually happening, just silent night kind of market, right? But all of a sudden you just see spikes caused by absolutely factors that you can't really explain. Okay, so in those kind of situations, let me use the Euro USD as an example. If I want to put a typical stop loss, let's say I want to go long on this particular trade. Let's assume my bias is long and I want to go long on this particular trade. As you can see here, the stop loss, typical stop loss here says is 30 pips, okay, which is totally fine by me in this kind of trade, because my ATR at this point is actually 13 pips. Okay, as you can see, keep your eyes here, right? So as you can see over here, when I move my cursor back to the current place of the chart, you can see the ATR is 13 pips. So 13 times 2 is like 26 pips, which is totally fine. So at every instance, I try to make sure that my stop loss is always 2 times at least higher than the ATR value, so that in a case where there is a sudden spike on the 1 hour time frame, most especially on the 1 hour time frame, it doesn't just just spike and just give stop out my trade, then moves back into the profit level that I was expecting that it would probably get. Okay, so this is something that you might actually want to consider and apply into your trading, and trust me when I say this actually works. It gives you much more fail-proof stop losses. Market manipulations, like the simple market manipulations that has nothing to do with news, hit your stop losses much more harder. Okay, it's much more difficult to actually hit your stop loss when you obey these very simple rules. Okay, so like I said, 2 times or at least 1.5 times higher than the ATR. So let's take another example. Let's say this is the GU. Okay, I'm not seeing any likely entry here. I just want to use a trading pair that we might just assume like we can get an entry based on the support and resistance levels. So let's do this. This probably looks promising. So let's say we want to put our targets here. Let's say we want to put our targets here, and the ATR value, as we can see currently now, is still 13 pips, approximately 14 pips over here, and the stop loss here is 31 pips, which tells us that this might probably be just a little bit higher. So we can move our stop loss much more, move it to, let's say, 25 pips. So about 25 pips, which is about 2 times the current ATR on the 1 hour time frame. Okay, now, but this is just like an overview of how to use an ATR. Probably you might just find better ways to do this for yourself. Okay, you know, some people that advise to use like 3 times the ATR, but however, if you use 3 times the ATR value to determine your stop loss, it probably will be very, very far. But it works a lot for swing trade. If you're a swing trader, you want to hold a position for, let's say, 2 weeks or 1 week, or you're hoping that the market reaches your stop loss in a space of 2 weeks. It takes that long to hit your take profit. Sorry, you might probably want to maybe use three times the ATR to determine your stop loss. Okay, but for the way I use ATR, I use it on multiple time frames. Okay, so I make sure, for instance, if I want to enter a trade, because the way we trade at the Trading Academy, our confirmation time frame is not our execution time frame. Our bias time frame is not our execution time frame. So we use multiple time frames to actually enter a trade for. Okay, so I make sure that my ATR is at least times 2 or times 1.5 of the both the time frame, both my confirmation time frame and my execution time frame. For instance, if I want to execute on a 1 hour time frame, I make sure that the ATR is 2 times on the 2 times the ATR on the 1 hour time frame, and at least 2 times 2 on, let's say, on a 15-minute time frame or on a 4-hour time frame. Okay, so I just use multiple time frames. I don't want to go into details because I'm trying not to give out some of the value that is exclusive to the Forex Bootcamp course and our Trading Academy students. Okay, so but however, that is how to do this. So I believe this can actually improve your trading and help you trade, like take really better trades. Okay, so that said, apply this to your trading, do your back test, and be sure this actually works. And of course, it works. Okay, if you're having probably, if your stop losses gets much more, hits, let's say 60% of the time before the market now moves your direction, probably this will probably reduce it to about half of that, maybe 30% of the time. Okay, so this is just to improve your trading. This is not, it doesn't mean that your stop loss will not be hit anymore. That's not true. Okay, but this will make it much more harder for your stop loss to be triggered in the market. So use the ATR, make sure that is at least 1.5 times or at least 2 times of the pip value, comparing that with your stop loss. Okay, make sure your stop loss value is at least 2 times or 1.5 times the ATR. Okay, so that said, I hope you're able to get some form of value in this particular video, this particular tutorial. So if you're yet to subscribe to this channel, seriously, man, I don't know what you're waiting for. Click the subscribe button, click the notification icon, so that every single time I do a video like this, which I do a whole lot, okay, you'll be notified and you don't miss out of all the beautiful value that we are dishing out here in this particular channel. And also, if you want to join the Trading Academy, there's a link below this video for you to actually join, or you want to be a part of our online course, there's also a link here in this video. So cheers, catch you some other time, bye.